Hey there, and welcome to This Explainer. I am absolutely thrilled to have you here today. As your financial mentor, we need to start by completely busting a massive misconception right out of the gate. You know the one? So many of us, especially when we're young and just starting out, think you need thousands and thousands of dollars in upfront capital to build real wealth. It's like if you don't have this massive lump sum of cash sitting around, the whole investing game just isn't meant for you. Well, I'm here to tell you that is completely wrong. Today, I'm going to prove it to you. We're going to map out exactly what happens if you commit to just $100 a week for 10 years. Okay, let's dive into this and see how you can build an absolute wealth machine completely from scratch. Now, I know what you might be thinking. $100 a week? That still sounds like a bit of a stretch. But let's break that down to its daily equivalent. It comes out to exactly $14.28 a day. Just think about that for a second. That is literally one skipped food delivery order, it's one fewer forgotten subscription service that you don't even use anymore, or just skipping one quick impulse purchase at the store. I'm pointing this out because I want you to realize that the barrier between you and life-changing wealth, actually scratch that, it's not even a financial barrier. You likely already have the resources right now. The only true barrier standing in your way is entirely psychological.
Section 1. The fear of starting small.
Look, I completely validate any hesitation you might be feeling. Starting from absolute zero is daunting. When you make those first few deposits, your savings feel frustratingly small. It is completely normal to look at a tiny account balance and think, is this even worth my time? That mental hurdle right there is the hardest part of the entire journey. So I always ask this crucial question: why do so many people quit early? Why walk away from a system that is mathematically guaranteed to work if you just give it time? Well, it's because that first year of investing feels like pushing a massive, incredibly heavy flywheel. You put in $100, then $200, then $500. By the end of year one, you've deposited just over $5,200, but your account might only be sitting at, say, $5,400 or $5,500. You've earned maybe $200 or $300 in returns. It's quiet, it's slow, and it's so easy to ignore. People look at that and think, this is going nowhere. But listen to me, that is an emotional trap.
I want you to literally burn this phrase into your memory. Year one is not about the returns, it is about the habit. Please trust me on this. That slow growth in year one is totally normal. What you are actually doing in that first year is building the invisible roots of your wealth. You are actively removing the mental friction of deciding whether or not to invest each week. You've already made the decision. The answer is yes, every single week, no matter what.
Section 2, Dollar Cost Averaging Explained. Okay, so let's introduce your primary tool for this journey. We are going to completely shift our focus away from scary market volatility and all those stressful headlines and look at a highly practical, stress-free system. At the core of that system is something called dollar cost averaging. This is hands down one of the most powerful yet wildly underrated tools in personal finance. It simply means you invest your fixed $100 every single week, completely regardless of what the market is doing or what the news cycle is screaming about. Think of it like a protective shield against your own worst impulses. By investing a fixed dollar amount, the math naturally ensures that you buy fewer shares when prices are super high, and you buy a lot more shares when prices drop. It naturally smooths out your costs over time without you having to lift a finger.
Trying to guess when to buy or sell timing the market is an absolute anxiety trap. Almost everyone who tries it gets it wrong, and it has a massive failure rate. But dollar cost averaging, it is automated, emotionless consistency. In fact, when the market drops and the news is totally doom and gloom, you don't panic. Why? Because you realize your $100 is just buying up shares at a major discount. It completely flips how you view bad economic news and entirely protects you from making those panicked, impulsive financial decisions.
Section 3. Surviving the Early Years. Now we're going to transition into the actual chronological story of compounding, but I gotta warn you gently here. Patience is absolutely going to be your greatest asset during this early slog. You simply have to give the math time to breathe. We already talked about year one being tough. In year two, okay, the system begins to feel a bit more real. By the end of year two, you've put in around $10,400 of your own cash, but your balance is inching closer to $11,500 or maybe 12 grand. Last year's returns have now become this year's principal. But year three is where a magical shift happens. Your contributions are exactly the same, still just $100 a week, but you start noticing that your account is actually growing on the days between your deposits. On days you add absolutely nothing, the number is still moving up. You've deposited $15,600, but your balance is roughly $16,000 to $17,000. This is your first undeniable sign that something else is working right alongside you.
But man, The real magic kicks in when we jump ahead to year 6. The growth stops looking like a straight, boring line. That curve finally starts bending upwards. Check this out. You've deposited about $31,200 of your own money, but your account balance? It's sitting somewhere between $42,000 and $47,000. There is a massive widening gap of over 10 grand between what you put in and what you actually have. That $10,000 is visual, tangible proof that compounding is now doing the heavy lifting for you. It's not just some theory in a textbook anymore. It's reality, and you can see it every time you log into your account.
Section 4. The compounding tipping point. This section right here is where I, as your mentor, get incredibly hyped, because this is where the math shifts from linear growth into explosive exponential growth. Let's map out this explosion across years 7, 8, and 9. In year 7, the returns generated by your existing balance actually start to rival your own weekly contributions. But year 8 is the absolute game changer. This is the milestone where your investment returns definitively outpace your contributions. Just think about this. You are putting in $5,200 a year, but assuming a conservative historical average of a 10% return, your balance is generating $6,000 or more in returns all by itself. The wealth machine you built from scratch is now producing more wealth per year than you're contributing. And by year 9, the original money you invested has essentially doubled itself through compounding alone.
Which brings us to the grand finale of our timeline, year 10. Let's break down this mind-blowing math. Assuming that historically grounded, conservative 10% average return from something like the S&P 500, over 10 years you will have deposited roughly 52 grand of your own hard-earned cash. But your final estimated balance? It sits somewhere between $90,000 and $110,000, maybe even more. Compounding alone has produced $40,000 to $60,000 in pure returns. And remember, that is money that required absolutely zero effort from you, except the discipline to just not quit. It didn't care if you had a fancy finance degree, it just needed your time and your consistency. In year 10 alone, your returns are $8,000 to $12,000 in a single year, all from this one simple habit.
But listen, I have to be real with you and gently warn you about the cost of hesitation. If you look at this and decide to delay starting this simple habit by just 3 years, your year 10 balance drops by roughly $15,000 to $20,000. And no, it's not because you invested that much less of your own money, it's because those super important early dollars are only compounding for 7 years instead of 10. Time is literally the only ingredient in this entire formula that you absolutely cannot buy back once it's gone.
All right, let's pause the story for just a quick second. I want to throw a little interactive pop quiz your way to really lock in this new understanding of wealth building. Based on everything we've just talked about, what percentage of the S&P 500's total cumulative returns do you think actually come from compounding and reinvesting, rather than just raw price growth or miraculously picking winning stocks? Go ahead, take a guess. The answer is a staggering 85%. According to an analysis from Hartford Funds, 85% of the S&P 500's cumulative total return comes directly from reinvesting dividends and just letting compounding do its thing. It does not come from picking the perfect hot stock, and it certainly doesn't come from timing the market. It comes entirely from reinvesting and waiting. You literally have a full century of historical proof backing up that number.
Section 5. Your action plan today.
All right, it is time to pivot from theory straight into empowerment. I want to prepare you to take micro-actionable steps right now. We are going to automate your wealth machine today. I've put together this incredibly simple 3-step checklist so you can get your $100 a week plan rolling immediately. Step 1, open an index fund account. Find yourself a low-cost S&P 500 index fund. Super easy. Step 2, automate your weekly transfer. Set up that $100 to pull right from your checking account every single week automatically so you literally never have to think about it. And step 3, never touch it. Just let the math do the work and maybe occasionally peek at that account growth just to smile. Remember, the financial system does not reward people who sit around waiting until they feel completely ready. It overwhelmingly rewards the people who start before they feel ready. I'm going to leave you with this final, somewhat provocative thought. The next 10 years, they are going to pass anyway. That isn't an option. Time is marching forward whether we like it or not. The only option you actually have is what you decide to do during those 10 years. Are you going to keep making those random $14 a day impulse purchases, or are you going to finally build a machine that works tirelessly for you in the background? Take immediate action. Open the account today, set up that automation, and let compounding build your future. You've totally got this.